Second day of underperformance when it comes to the broader region, and of course this being the first day of the financial year.
Nadine, it certainly was a disappointing one, and of course we did receive some fairly negative leads from the US and European markets overnight, and really we did struggle to gain momentum for most of the day after these global markets failed to generate a lot of confidence in our market. It was interesting leading up to around midday today. We were trending upwards, and I do suspect it was around that expectation of that higher Chinese manufacturing read coming through, which of course we did see, but then of course after midday we really did see the market fall right off, and of course after we did get that RBA rate decision as well coming through, it was that materials sector that was interesting and held up our market for most of the day. We did see that iron ore price coming off overnight. It was down around 1.2%, but if we do have a look at a lot of those iron ore players, Fortescue, Atlas Iron, BC Iron and Rio, they were all very strong performers today, and I do suspect that was a result of that strong manufacturing read that we did receive, but unfortunately it was a pretty disappointing day for the start of the financial year.
Leanne, were you surprised that we didn't see any sort of a reaction in those building stocks?
I certainly was a bit surprised, Nadine. That was probably one of the interesting points out of that RBA rate decision. Of course, they indicated that strong expansion in that housing construction sector is in fact underway. We do in fact remain pretty positive on the outlook for that sector. We have been for quite some time now. We know that building approvals are running at 3-year highs at the moment, and if we have a look at the compilation of that building sector, if we have a look at apartments, they in fact now account for about 47% of building approvals, which is in fact quite well above the historical average of around 32%. Apartments typically have been sort of less materials intensive, and they take a little bit longer to complete. So as a result, we could see some of these volumes lagging behind that headline building approvals rate, and may see some of those earnings coming in later than expected. So as a result, we do remain very confident in the outlook for that building materials sector, but we see probably value in the later cycle exposures that are more leveraged to sort of the completion cycle, but certainly reiterated our positive thoughts on the sector.
Quite a while through the session, really dragging on the market. It was one of the worst performers. It finished off by about 3%. Leanne, where to from here? It was sort of an underwhelming response from the market in regards to this restructure that it's undergoing.
Nadine, it was an underwhelming response, pretty negative, as expected. Of course, we got those restructuring announcement and the write-downs as well in terms of their financial year 14 guidance that's come in at the lower end of their guidance range. We're in fact expecting that to come in even lower at about 109 cents per share. So as a result, we have in fact revised or made some minor changes to our earnings per share forecast, in fact, of about 0.3% in 2014 and about 0.8% in 2015. So we do expect to see some fairly modest earnings per share growth, about 6% in 14, 7% in 15, and about 15% in 16. But overall, we really do think that the key issue with this company remains around their organic sales growth. So given that restructuring that we have seen through, we've only seen about 1% growth in organic sales in the first half of 2014. And of course some of those ongoing patchy conditions which are coming through from some of their competitors, we really do remain pretty cautious on Ansell's underlying organic growth coming into the second half of 2014, and it does look pretty expensive at the moment given that earnings per share growth profile as well. So given those write-downs and restructures, we do remain pretty cautious on the outlook.
Okay.